Hello, my friends, and Merry Christmas. There is no Markets Weekly this week, but instead, I thought we would have a Markets Outlook 2024, where I talk about where I think we are in the markets and in the economy and where we will be heading next year. Now, to be perfectly clear, I don't have a crystal ball. This is simply my best guess as to how things will unfold in the coming months. Remember, a lot of things can happen between now and the end of next year. This is simply my best guess. Now, before we begin, let's see how I did last year. Okay, so last year, at the end of last year, I recall there was tremendous doom and gloom in the commentary. So a lot of people were thinking that we were going to head into a recession and the markets were not happy. So I didn't think that would happen. So at that time, when the S&P was trading at 38.15, I was thinking we would be fine this year and end up above 4,100. And man, did the market far, far exceed my expectations. I'm not sure if many people expected the S&P to do as well as it did this year. Secondly, I was thinking that the 10-year yield would end the year above 4.5%, and it looks like we're ending the year below 4%. So I got that one wrong. But to be fair, though, we did see the 10-year yield soar and touch 5% before retreating to where it is today. And maybe it will go back up next year. We'll see. The third thing that I was speculating on was the Euro USD exchange rate going below 1. And there's no way around that, got that really, really wrong. At that time, I was thinking that the Fed would basically out-hawk all the other central banks. Now, looking across the world, I was seeing that the US economy was doing much better than everyone else, and the US economy was much more interest rate insensitive. For example, basically everyone in the US has a 30-year mortgage, whereas many people outside of the US have floating rate mortgages. But to my surprise, it looks like the Fed is going to out-dove everyone else in the world, as we talked about last week. So this is just not going to turn out. And lastly, I thought gold would end the year above 2,000, and that did work out. So all in all, 50%. I'll take it. Okay, now let's turn to where things are today. So I guess the big question on everyone's mind is, are we heading into a recession? So short answer is, I don't think so. I don't see that at the moment. Now, at a high level, a recession is basically when an economy produces fewer goods and services this year compared to the last. For example, let's put it in car factory terms. If you have a car factory that made 100 cars last year, but this year you're producing 99, you're producing fewer cars. And if you were the entire economy, you would be in a recession. Now, when an economy produces fewer goods and services, it could be due to supply or it could be due to demand. For example, you could have less demand for goods and services and thus fall into a recession, or you could have supply constraints. Let's talk about each of those factors separately. First, when I think about demand in an economy, I think about money. So when people have money, then they can spend. There's demand. So where do people get money? Well, first, they can get it through wages, they have a job. Secondly, they can get it through wealth, asset appreciation. Or third, they can borrow it. Now, let's go through each of these sources of money and see where we are today. Now, when you're looking at the job market, it looks really good, actually. Looking at a chart of the unemployment rate, our unemployment rate is at multi-decade lows, and it looks like it's been there for some time. And the mirror image of this, of course, is that wages continue to grow at a historically high rate, right? You have a very low unemployment rate, suggesting strong demand for labor, and so wages continue to rise. At the moment, it looks like wages are rising at around 4% a year. Now, as long as you have strong wage growth, which we do, and as long as jobs are plentiful, like no one's losing their job, which at the moment doesn't seem to be happening, then people can continue to have income to spend, right? So that's demand. And as inflation declines, so that income is going to be able to have more purchasing power. So this income side looks fine. Secondly, What about spending from assets? Well, if you look at a chart of household net worth in the US, so assets minus liabilities, as of the end of third quarter, it was around all-time highs. Between the end of third quarter and now, we've seen the equity market go to the moon. So I'm pretty sure that household net worth is at all-time highs right now. And if you take a step further, you also notice that from a demographic standpoint, a lot of that wealth is held by boomers, right? Boomers grew up in a world where they could buy a house for like $10, and then now that $10 house is worth like 10 million, something like that. And of course, they were buying stock when it was cheap, and stocks have appreciated a lot. Now, boomers are retiring, and so they have a lot of wealth to spend. They're not working anymore, but they've accumulated a lot of wealth. Think of the boomer that bought a house in California, or think of the boomer that just started putting some money in his 401k, and they have a lot of wealth that they can continue to spend. Now, to be perfectly clear, the distribution of this wealth is uneven, and we have a lot of people who don't have a lot of wealth. But, keep in mind, 60% of the people in this country own a home. Home prices have gone up a lot. You have a lot of people who are involved in things like tech stocks and crypto, and that's all gone up a lot. So anyway, looking at an asset perspective, looking at net worth, it looks like people have a lot of wealth they can continue to spend to sustain consumption. Now, the third thing that I'm looking at is, of course, borrowing money. Now, you can think of this, most obvious example would be the housing market, right? So now that the Fed appears to be, at least interpreted to be very dovish, and interest rates have come down a lot, in the coming weeks, I would expect to see mortgage rates with a 5% handle. Now, that's very likely going to ignite tremendous amounts of demand for housing. And of course, if you're wanting to buy a car, car loan rates will come down a lot. In fact, the most recent data, we can see that housing starts are already surging. And if you look at home builder stocks, that are also surging as well. So again, as rates come down, more and more people are going to be able to borrow, willing to borrow because it's cheaper to sustain consumption. Now, this also ties in with high net worth, right? If you have an income, if you have a good net worth, good balance sheet, and if you have a job, then people are more willing to lend you money. And if interest rates come lower, you're more willing to borrow. So again, looking at the demand side, the totality of this, it looks like demand is going to continue to be fine next year. And indeed, if you look at the trajectory of economic growth over the past year, it's been pretty good. Looking at the Atlanta Fed Now GDP nowcast for this quarter, it's ticking up towards 3%. Now, we think of the economy's underlying potential growth rate as 2%, so we're growing above trend, above potential at the moment. There's a lot of momentum here, and it looks like it's going to be sustained throughout at least the foreseeable future. So from the demand side, I don't see any problems in sustaining the economy. Now, what about the supply side? What if we have more supply constraints that make it so that, let's say, going back to the car example, you can't get chips, and so you can't produce as many goods and services as you want. So broadly speaking, over the past few years, since COVID, we've seen supply chains improve. Now, improvement has been uneven, but it seems like it's getting better. Now, more importantly, though, when I look across the world, it looks like in the Eurozone, they're heading towards recession. In China, the economy's not doing well. So globally speaking, outside of the US, things are slowing down. Now, globally, we all use the same supply chains. So, for example, let's think about things like commodities, right? It's a global market. Now, if we have slower demand in outside of the US, that frees up supply capacity to serve the US market. And so it doesn't seem to me that supply is going to be a constraint as well. So you put this together and you get a picture of the US economy that's doing fine. And to me, I don't see any signs of falling into a recession. So that's one thing. Now then, establishing that's how I think about things going forward, where does that leave markets? So overall, I have a very, very positive risk view for markets going forward, and I've written about that a couple weeks ago. So at a high level, What I think is happening is that we are in a quote unquote crack up boom. Now, crack up boom is typically speaking when you have, I guess you could say, the debasement of the monetary system. It could be through excessive credit growth, for example, like that decreases the value of the currency, and so asset prices inflate. Now, that's one way to look at that, but it doesn't actually have to happen necessarily through excessive growth in bank loans. I think it could also happen through excessive deficit spending, because in the modern monetary system, when you are deficit spending, you are basically printing US treasuries, and treasuries are very much a money like asset. So when the US government is, let's say, conducting a lot of deficit spending, I think of it as them buying goods and services and paying for it by printing treasury securities. Now, again, a US Treasury security, I can't use it and go pay for dinner at Denny's. But if you give it to me, it's an asset that I can monetize. I have more purchasing power. My net worth goes up. So the creation of US Treasury securities, the printing of those things, is basically a form of helicopter money. And we've been doing that to a surprising extent. So we had an economy that did well this past year, and deficit is about 7%. And if you look at forecasts, it looks like it's going to continue to increase going forward. I think that's just where we are as a country, as a politics, or politics and our culture are. When I look around, what I see is that people like to have free stuff, and the politicians like to give free stuff, so that's how they get elected. So you have President Biden again forgiving student loans, and now they seem to be wanting to give money to people to buy homes and so forth. So I think that's a very strong trend going forward. So the deficit is going to continue to increase. So you can think of it as helicopter money continuing to increase, and that's really really bullish for financial assets, right? You are, in a sense, you are printing money. Now, usually, again, in a system, you have checks and balances. Now, for when the government goes and does something like this, you usually have two checks to keep it from doing this. One, of course, is the quote unquote independent central bank that could raise interest rates and push back against inflationary spending. And the second, of course, is market-based checks, where the bond market becomes unhappy, and so that arouses public concern. Now, so far, we had these two things occurring and pushing back against the deficit spending over the past year. So we had the Fed, of course, hiking rates to 5.5%, and we saw the 10-year Treasury yield touch 5%. Now, the Fed seems to be doing a 180 and heading towards rate cuts, and the bond market seems to be convinced that everything is going to go back the way that it used to be. And so we have the 10-year yield heading below 4%. So these two forces that I would think of as working against the inflationary impacts of deficit spending are going to sleep. And so I can see this as removing hurdles for the S&P to continue to soar, maybe to as high as 6,000 next year. Again, I have no idea exactly what it will be, but I think there is extreme upside risk in this scenario. Now, one of the things that we've noticed over the past 10 years is that when you run loose monetary policy, you don't necessarily get, let's say, inflation in goods and services. After all, that's dependent upon things like, what the money is spent on, who has the money, and just the supply aspect. Are you able to produce enough oil and so forth? But what we did notice over the past 10 years is that it was very inflationary for financial assets. I think the reason this is that in our society, the income and wealth structure is very unequal. So at the end of the day, when money gets poured into the economy, it funnels through, but ultimately it ends up in the hands of very few people, very few very wealthy people. And what do wealthy people do with their money? They go and they buy assets. So I suspect that deficit spending is going to have a similar impact, where the money they inject into the system is ultimately going to funnel into the hands of a few people who go and buy assets like the S&P 500. So that's my outlook for the S&P, for the stock market. Now, I have been a noted bond bearer for the past 2 years, and I continue to be. So the way that I look about this, of course, as we all know, is just supply and demand. If you have the supply of Treasury securities to be basically, infinite with no end in sight, there's never any talk of how to get the deficit under control, and that's not going to be good for the price of Treasuries. And that is to say, yields are going to go higher. We had this pretty dovish turn from the Fed that's been, I think, prompting a counter trend rally, so forth. And at the same time, I think we have basically two generations of investors who grew up in a bond bull market and continue to think that the future will affect the past and that we will go back to where we were before. So I firmly believe that the future will not look like the past. So on the one hand, of course, we have this tremendous amounts of fiscal spending that will be inflationary. But on the other hand, on the other side, we also have this structural decline in the labor market. This is just demographics, right? So in the 1980s, people decided to have smaller families, and so our workforce population today is simply not growing at the same rate that it used to. And so as a result, there is a labor shortage. We can see this everywhere, right? We see this in high wages, and we see this in the power of the unions. Now, that's something that's structural, and that's going to continue as boomers retire and they are not fully replaced by the new generation. So again, that's pretty inflationary as well. And you have these geopolitical things that people talk about. I think that there's validity there, but it's just not, it's kind of vague to talk about. So I can't put too much weight on that. But the demographic aspect, though, that's very clear and that's already happening. So again, the rampant fiscal spending and this demographic change, I think, is going to make inflation and thus interest rates secularly trend higher in the coming years. Now, eventually, I think this is going to be more widely understood. So I still expect the 10-year yield next year to continue to trend higher. I mean, as people watch the S&P soar, as people watch inflation perhaps stabilize between, let's say, 3 and 4%, I can see the 10-year again rising above 5%. Again, I've been saying this for some time, but for me, it's really hard to imagine a world where interest rates don't trend higher. Actually, if you ask anyone, let's say 100 years ago, from the US, or anyone today who is, let's say, from Brazil or some kind of middle income country, and just point to these, fiscal policy, point to monetary policy, and so forth, and they could all tell you immediately that interest rates are going to go higher because that's inflationary. I don't think that U.S. investors have that sense yet, but I think they will get there. Okay, so this year I don't have any view on the dollar. Again, the dollar is going to be depend upon the decisions of the Fed and the other central banks, and I'm getting the sense as we go forward, as we go into an election cycle throughout the world, there's going to be some more politics involved, and I don't have enough insight, or I don't have any view on that. And okay, the last thing I'll talk about is gold. So gold, of course, has been well sustained, and also it's been, I guess, being accumulated by central banks. Now, gold people often talk about as a reflection of things like inflation or real interest rates and so forth. So everyone views gold differently. So I think of gold as basically a combination of all those things, but at the end of the day, it's kind of a hedge against the monetary system. Now, I've talked about how the US doesn't seem to be well managed, but it's kind of the same thing everywhere in the world. And as this mismanagement continues, I think there's going to be more and more interest in gold. And on top of that, of course, we could also have the potential for geopolitical flare-ups. So rather than talk about things like relative currency strength, it seems like people are probably going to just buy some more gold as a hedge of what we're seeing in the sovereign space. So I think gold continues to trend higher. I think we can go up, let's say, so we're at 2,000 today, to go up another 20%, 2,400 for next year. All right, so those are my three views for next year. Massive bull market in equities, bond market sells off, and of course, gold bull market continues. Let's see how I did next year. All right, guys. If I don't see you before then, Happy New Year. And thanks so much for watching this channel and supporting my work. I really appreciate it. Talk to you guys soon.